Andrew Briggs. He's a director of portfolio management and a wealth manager at Steward Partners Plaza Advisory Group. Good to see you here. Andrew, I'm sure you saw at the top of the show, investors sticking with the hot trades. Is that the right play?
Yeah, I think you have to right now from a safety perspective. There's still a lot of uncertainty out there as we go into 25. Obviously, with inflation picking back up, or I should say, no longer disinflating, and then you throw in the new administration coming in 2025. There's just a lot of uncertainty, as that's been echoed in the corporate calls as well this past earnings season. So, I think until there's some more clarity, it's tough to kind of broaden out that portfolio too quickly and leave, if you will, those safe defensive names that you guys have been mentioning.
Is the clarity in the form of the economic outlook? Is it in the form of earnings growth estimates even? What is kind of the major measuring stick that investors should be using in order for that clarity to really play through to some of their portfolio picks?
Yeah, good question. I think it's more on the, I would say, the former, the economic side of things, as far as the labor market is throwing a lot of mixed signals out there. Not a lot of hiring, but not a lot of layoffs. So first and foremost, I think need to get an understanding of exactly where that sits, and then obviously throw in, I keep mentioning the new administration's impact on that, whether it's from immigration. What is that going to look like for the labor market, which has a direct impact on the consumer in the markets. Earnings-wise, I would say quickly, you are starting to see some manager sentiment deteriorate there. Again, it keeps going back to the administration and what is really going to occur over the next year or two. There are lofty earnings, as we all know, whether it's upwards of 12, 13, 14% plus earnings expectations. So as we hand the baton from kind of valuations carrying the market to what people are expecting to be earnings, it is a high bar, and I think it's going to be a lot to ask to have the so-called same 5 to 10 names carry that slack.
If one is concerned about that earnings growth slowdown next year, Andrew, what are some top defensive strategies they could put into place today?
Sure. So I think even if you just take the AI theme from that standpoint, as we kind of get into potentially the second or third phase, we've already seen that kind of breakout in the utilities area, if you will. Those are no longer the kind of traditional boring utilities that many people have been accustomed to. Same thing with the material side and even the software side as well. What is this going to look like as over the next decade, some of these AI themes continue to morph into the next beneficiaries of there. So we think those are some smart plays. And then additionally, again, going back to the policy administration, what's coming up here is if we get some more clarity there, it would be interesting to see from a market cap standpoint if some of the small and mid cap names could start to make sense if they get some more firm ground from a financial standing. So a little bit more clarity again on what are interest rates going to do, as those companies are obviously much more directly impacted by those rates.